Hi, everyone. Thank you for hanging out till the very end. I'm not sure why other speakers didn't use the stage, but I think I will. So I think the goal is to be different. I will jump right into the presentation. I don't want to waste any time. I've said it several times here. I guess I'm standing between you and lunch. This is the first time I get to say I'm standing between you and sleep. But that's great. I actually like these evening ones, evening events, and thank you. Thank you for having me up here again. This is my second Bitcoin Wednesday. I think I was here in 2016, gave a presentation about the history of Bitcoin. Wanted to do something a little different here. There were a couple of speakers earlier that said a couple of interesting things. I might bring them up later if I actually remember them at the time. So I'm not going to talk much about myself. You can just Google me, Tone Vays. I have multiple podcasts. One of them is a crypto scam podcast. I have a couple of episodes I need to actually edit. There's an audio version. Former Wall Street, I was there during the financial crisis at Bear Stearns, then moved on to JP Morgan. Left that world in early 2015, started trading and speaking about Bitcoin, and now I have a YouTube channel and travel the world and speaking. So this presentation started out being called the Inevitable ICO Bubble. I've changed the name of the presentation, but I haven't changed the slide yet. It should now be called Has the ICO Bubble Popped? Because I've been doing this presentation around the world for like a year before the whole bubble thing happened. So what was happening very early this year, at the very height of the market, people were constantly like sending me messages and emailing me wanting to be their advisor, which is was getting to a point where I had to alter my LinkedIn description, which for this entire year has said, I am not interested in your ICO or token sale. Please send all requests to Vitalik Buterin instead, who is responsible for this nonsense. To know why your ICO token sale is probably a scam, here is my hourly consulting rate, and I will be happy to explain it to you. Though I really hated those phone calls. They were very, very frustrating. But some people did pay to find out. So I had about 3 of those. So how did I come up with this, right? So I was not really around for the dot-com bubble. I was still studying. I was still in college. But I remember how it really went. And the most interesting part is, here is the entire NASDAQ bubble. And you can see how the top of the NASDAQ was reached, I think it was like, what was it, March? Yeah, March 2000. We did not break the top financially until 2015. 15 years, that was March exactly. Exactly 15 years it took for the valuation of the NASDAQ to go back to all-time high. But what was happening during those 15 years? Did the internet ever take a hit? The internet was being adopted exponentially. I mean, smartphones came out in 2007 or 8, I don't remember, one of those, when iPhone was launched, right? But the valuation was different. So people always say, because I've been a bear on the price of Bitcoin this whole year, and people are always like, well, you don't believe in the underlying technology. I'm like, no, I believed in the internet for 15 years. We never got to that valuation. So things can be very, very different. So we're gonna zoom in on what actually happened during the dot-com crisis. And like even as far back as 1996, Alan Greenspan referred to it as irrational exuberance, but the bubble was just getting started. Yahoo went IPO right before that. That was one of the first high-profile IPOs. That was also in 1996. The IPO was obviously mispriced at the opening, but it was the early days. And on the first day, the value of Yahoo stock went up 50%. It closed at $33. In today's prices, when you adjust for splits and stuff, it's about $1.38. The next really big notable IPO was Amazon. That came in 1997. That IPO went up 31%, and it closed at around $23.50. That's about $1.50 after you adjust those for splits. Okay. Oh, okay. Then it starts to get a little bit interesting. You know, I'll save pets.com for later. That's a great example of a couple of things I want to say. But things started to get out of control around 1998. In 1998, a new record for opening day's IPO was created, and that, so in 1998, the Globe.com went IPO. So the Globe.com was going to offer everyone to be kind of like their own internet. Kind of like today, everyone is trying to convince everyone that everyone should have a token and that you should have your own money. But back then, everyone was trying to convince other people that they should be their own internet. So that's what the Globe.com was going to do. It was going to give you kind of like your own internet environment. You're going to be your own website. And that IPO went up 600% on the first day. The closing price was $63.50. And at one point, I believe that stock traded at about 87. It traded at 87 at one point that day, closed at day 63, and it was still 600% above the expected IPO price. Of course, this whole thing didn't last very long. The company pretty much went bankrupt a few years later. But as it launched, pretty much anyone involved with that company became a multi-millionaire. Even their web developers were worth like over $100,000 immediately. And that was interesting. Now, that was a record. That record didn't last very long. That record was broken on December 9th, 1999 by VA Linux. The IPO opened at $299, and that was 700% above the expected IPO price. What did VA Linux do? VA Linux was going to build your custom-made Linux system. That company had a reasonable amount of hype, and there it is. You can see the whole stock chart. It basically opened up at $300 a share, and then over the next year, it pretty much fell to about $7 until eventually it went under $1 and got delisted. The stories started to get really crazy towards the end. I actually remember Cyber Rebate. Anybody else remember Cyber Rebate? Yeah, a couple of hands went up there. So Cyber Rebate had an amazing business model everyone thought was going to be the future. So basically, back then, what were the popular electronics back then in the 90s? Like Discmans. This is before, I mean, MP3s were just starting to come out. But like Discman was still popular. So they would sell you a Discman at like 10 times the retail price. That was basically the business model. Your Discman is $20, they sell it to you for $200, but then you can request a rebate for the entire value of the item. Their business model was that half the people will forget to request the rebate and they will just get to keep the money. So they blew through millions of dollars in funding. There were about 10 people that they owed approximately $100,000 to each, and those people ended up getting paid about 8 cents on the dollar. So I actually don't remember if I got all my rebates or not. But some of those deals got really insane. AOL ended up buying Time Warner Cable for $156 billion. So that is bigger than our entire cryptocurrency market cap combined. And neither AOL nor Time Warner Cable have been doing very well ever since. But some of the stories ended really well, right? Like like the list. We're gonna get to this in a minute. Like the list of insane failures in the dot-com bubble is massive, but there are a couple of successes, right? Because it's all about who can get out at the very top. So let's talk about a little story of who got out at the very top. Broadcast.com, formerly AudioNet. So I think around 1998. Mark Cuban was really interested in listening to his college basketball games on the radio. So he invested $10,000 into a company. It had a different name at the time. Actually, that was 1994 was when the company started. So Mark Cuban might have invested the $10,000 a little bit earlier. But by 1995, Mark Cuban basically convinced the CEO of that company that he should be the CEO because he was going to take it to the next level, which he actually did. Changing the name to AudioNet and going public on the stock market in 1998 basically made Mark Cuban $300 million from his $10,000 investment. About 9 months later, Yahoo decided to buy them out. And at the time of the buyout, Yahoo evaluated the company that for every listener of broadcast.com at the time, they valued each listener at $10,000 a person. Yahoo ended up buying that company for $5.7 billion in stock. Mark Cuban became a billionaire, cashed out, sold the Yahoo stock, and Yahoo delisted broadcast.com 2 years later. So that was a $5.7 billion deal that 2 years later was pretty much worthless. If you can sell at the top, that's great. But as we know, and as we're seeing right now, how many friends do you have that are holding ICOs that are telling you the moment it goes back up, I'm going to sell? Right? Exactly. Almost every head should go up. So the list of companies during this 80% correction is pretty massive. Some of them were very, very interesting, and they were very, very reminiscent. So here's one example, eDigital Corporation. So basically, a company changed its name from Norris Communication to eDigital in January 1999. By changing its name to eDigital, the stock went from 6 cents a share immediately to $2.91 a share, and ultimately reached a high of $24.50 a share. From 6 cents to $24.50 due to a name change, okay? And have we seen this recently? Well, there was a couple of examples, right? Well, one of them was some penny stock company that was trading for about 5 cents announced that they were going to do an ICO, and all of a sudden their stock rises to 45 cents. The SEC got involved a couple of weeks later. This was a more interesting one because it's identical to the, if anyone remembers this, identical to eDigital, right? So the Long Island iced tea company changed its name to the Long Island Blockchain. And what happened? Well, the company, the stock of that company went from about, looks like about $2.50. The stock immediately went up to $9.49, at least that's what it says in the print. If you look at that picture, it's clearly went all the way to $15, right? So you print the story, and then an hour later, Bloomberg publishes the story, and the stock had already doubled from where you printed it an hour earlier. So, of course, I'm assuming the SEC got involved in that one as well. And the quote's really interesting, right? It's so reminiscent of what happened in the 1990s, says Scott Norris, author of A History of the United States in 5 Crashes. A company that had nothing to do with the internet would put out a press release that they were going to become an internet company, and the stock would absolutely soar. So we were already seeing this. So as you can see, everything that happened before is pretty much happening again. Here's a good one, pets.com. Everyone loves to use pets.com as a kind of like the laughing stock of the .com bubble. I don't. I mean, there's really no difference between pets.com and Amazon, right? One started selling books, the other one started selling pet supplies on the internet. No one really knew who was going to be the winner, right? In fact, not even Amazon knew who was going to be the winner, because most people don't know Amazon was the biggest investor in pets.com. When pets.com was going public, Amazon had the biggest stake. So even Amazon didn't know. And this goes to this idea that people are trying to convince regular people that, you know, the wisdom of the crowds is great, and you should be able to invest in these speculative projects. But in reality, even the professional VCs, it's their job to get the winners right. And even they can't do it. I mean, even Amazon didn't know that pets.com was not going to succeed, right? So what does the average person have? And the common story, people like to use Facebook as the main example. You should have had a chance to invest in Facebook pre-IPO. How come only the rich got richer? The reality of the situation is that every person that would have had a chance to invest in Facebook as the pre-IPO, all of your money would have been in MySpace, just like my money would have been in MySpace, right? So, and MySpace had competition, right? There was Friendster, there was High Five, there was Wimit, there was God knows how many of them. Nobody knew Facebook was going to be the winner, and especially a person with a day job that has no time to research this stuff. So unless you have the money to invest in every single one of them, and guess what? Investing in every single one of them will probably lose you money as well. The time to invest in Facebook was after the IPO. And I remember those days, actually. I got a phone call from one of my friends, and she was like a CPA accountant from one of the top 4. And this was like a week before Facebook was going public. And she calls me up because she knew I was into stocks and I understood that stuff. And she's like, Hey, so I have someone on the inside, and they are willing to sell me and my mom a bunch of Facebook shares at $40 a share, and it's gonna open at $42 when it goes IPO next week. So I can buy at $2 lower right now, and I think this would be like the first stock for me and my mom to put our retirement money in from the start. And I'm like, oh boy, God, Facebook is so overpriced at the IPO. Why would a professional investor sell it to her, $2 under the opening price? So what happens to Facebook at the IPO? It was so hyped. It opened at 42. It spiked up a little bit by like $1 or $2, and then immediately crashed. Facebook fell to about 20 bucks, rebounded to about 25, ultimately bottomed out at 17 when everyone got so frustrated because it was so hyped for the general public, because the general public usually loses. But after that, Facebook went to 200, okay? You could have made easily 10 extra money on Facebook after the IPO, after it was already a winner of the social networking game. Because if you had a chance to buy it before that, and this is why there are rules and regulations, right? This is why you have accredited investors. What makes someone an accredited investor? The fact that they have money. It's the fact that they're not gonna blow all of their savings on something random, which is what you're seeing a lot from the ICOs. And I'm okay with that. I'm actually perfectly okay with that model. So there it is. There's pets.com. It went public not too long after Amazon did. And it didn't do as well, but nobody could have known, like I said, not even Amazon. So, and if you guys think the idea of the internet currency is new, let me introduce you to Flues. Super Bowl commercial, guys. Just hit the play button. There it is. Yeah. We have audio, right?
Gotta get a gift for a kid. You don't know what they want. Push them all. Give them Flues on my gift cards. It's just like when you say goodbye to email list at some of the web school stores and you come out here. And smart. Graduation pick. Duh.
Cool. So Flues was basically money for the internet. It was an attempt to make internet money back in the 90s. But here was the problem. It was centralized. And this is the problem that Bitcoin solved. So by Flues being centralized, in 2001, Flues.com was notified by the FBI that the Russian organized crime syndicate was using Flues and stolen credit card numbers as part of the money laundering operation, in which stolen cards were used to purchase currency, then redeemed, and there it is. And Flues ended up, blowing through 35 to $50 million of investment capital. Here's another interesting story. Run across this one as I was researching this entire article, and that was very reminiscent at the time I was doing the research. And the story went like this. I knew a guy that had a company that was going to do something interesting in the field of communication. So he raised a little bit of money, hired some people, built a nice website, and most importantly, created a really nice billboard. Well, what did that billboard give him? Well, another company with a bunch of money to spare decided to buy out his idea for $100 million and gave him a contract that he has to stay with the company for 3 years and integrate his idea into the company. Within 3 months, they realized he was kind of useless. So they said, hey, why don't you go ahead and leave, take your $100 million, and we will integrate your idea. So what did the guy do? Well, he said, well, my idea was kind of a billboard, so I might as well use a bunch of that money and short the company, making himself another nice $100 million. So again, it's all about what you do. And here is the point in time that I was researching this story. This was during last year's consensus. And what do I see up on the billboard? Just as I was doing the research. So I thought that was hilarious. For those of you that aren't aware, that is EOS on the billboard in Times Square. Let's see how that project turns out. I don't have very high hopes. It's probably the most centralized of the databases. However, I do believe that the ICOs need a centralized database. So I believe that the winner of the underlying ICO platform will be the most centralized platform you can find, because none of these ICOs actually need a decentralized platform. They actually need their ICO to be sold as quickly as possible to another person, and a decentralized platform does that in the most inefficient, most expensive, most annoying possible way, so that's not exactly what an ICO needs. But that's a different presentation. So how do a lot of these things end? Well, how many of you saw the movie Wolf of Wall Street? Hope every hand goes up, right? There was something very interesting in that movie, and it only lasted about 15 seconds, and most people did not catch it. So Jordan Belfort did a lot of stuff, well, besides a lot of drug stuff, and but what did he actually go to jail for? Most people didn't catch that part of the movie. So let me remind you of those 15 seconds.
An IPO is an initial public offering. It's the first time a stock is offered for sale to the general population. Now, as the firm taking a company public, we set the initial sales price, then sold those shares right back to our friends. Yet, look, I know you're not following what I'm saying anyway, right? That's okay, that doesn't matter. The real question is this: is all this legal? Absolutely fucking not. But we ain't making more money than we know what to do.
Everybody catch that? So the common complaint that you get from a lot of people doing an IPO is, well, doing an ICO is, well, doing an IPO is too expensive. We can't do an IPO, it's too expensive, we need millions of dollars, such a monopoly, only Goldman Sachs or JP Morgan or Deutsche Bank, only these big companies are allowed to take you public, and it costs so much. Well, because this is what happens when it doesn't, right? Because when Jordan Belfort can take your company public, they give preferential treatment to their friends. They set the price. They hand out, you know, the pre-IPO shares to influential people, so they can, use. I think cell phones were just coming out, or maybe just before that. I'm sure he had one, and so that's what pretty much happens, right? And you're seeing that. I saw that evolve. Like, oh, I'm going ICO, like the Ethereum just went ICO, but everybody else is like, well, now you have pre-ICO. Well, now you have the pre-ICO, right? Because now you want to give a bunch of shares to people that can tweet about it, a bunch. This is how, you know, John McAfee can charge like, what was he charging? 20 Bitcoin for a tweet or something like that, right? So this is what happened. So all of the advisors, a lot of the people that are working with it, so they got a bunch of tokens, and now they're incentivized to, you know, sell it the moment it goes ICO. The same exact stuff was going on in the IPO market, and this is why only very few companies right now are able to take companies public to prevent that. Big players went away as well. So this was a very big player, Frank Cadron, who was actually, I think he took Amazon public and Netscape public, and they went after him as well for giving preferential treatment to certain clients, giving them a heads up on certain IPOs and selling them preferential shares early because of the insider information. So this brings us to the conclusion of the presentation, and there were a couple of other things I was thinking about as it was happening, because I do remember a couple of things during that time. Like I said, I was still in university. I was like 18, 19 years old when this was happening. And one of my friends in my dorm room was studying finance, and he said he borrowed like $1,000 from his older brother, and he's like running to his room trading penny stocks. And I remember those days, but I didn't really see it till it happened here in the crypto space. Why did the dot-com bubble get out of control? You'll hear stories, right? Hey, when your taxi driver starts telling you about the latest stock, the latest IPO, you know, it's time to get out. Or when your barber does it. I have a funny story. Like actually, my barber wanted to buy a Bitcoin for me at like $14,000 and $16,000. I'm like, oh, this is not good. This is going to end very badly. This was last year. But but how did that happen? How does a taxi driver know about IPOs? How does your barber know about IPOs? And I think that was mostly because of online brokers. Those .coms came with brokers. E-Trade, Scottrade, who remembers the E-Trade baby commercials from the 90s? There you go, right? So now you are able to trade from the comfort of your own home. right? Before the movie Wall Street, there was the movie Boiler Room, right? Before Wolf of Wall Street movie, there was Boiler Room. But during the days of the Boiler Room, you have to make phone calls. You have to solicit people. But you're not just going to call random people. You're not going to call the taxi driver, right? You're going to call the doctor, the lawyer, the accountant. You're trying to get people with money to buy into it. But with online brokers, anybody can do it from their home. But technically not anybody, right? You still had to be 18 years old. You had to have a bank account. You had to reside in the jurisdiction of where you're trading. If you're in India, you can't trade U.S. equities, so you had to have U.S. So there were some restrictions. There was age. You needed a bank. If you wanted to be a day trader, you needed $25,000. That's the 3-day rule that people don't seem to understand. But now in the crypto space, anyone can actually be a trader. There is no geographical restriction. There is no banking restriction. There is no age restriction, which is actually hilarious. I have a little more on that one. And there's no financial restriction, right? You have $100 to your name, please go gamble on an ICO. Like, no one is stopping you. So the age restriction is really funny. These are real emails. Dear Mr. Vays, I am 15 and a half years old and in high school. I am interested in Bitcoin and is asking for trading advice. This one is actually even better. Someone is asking me about some coin and I reply, no, I don't really care for them. And the answer is, well, I like it, but I'm 13, so I would, LOL. And I'm like, not sure what that means. And he has to clarify, I'm 13 years old, so I would like this gaming coin. Because when random people text message you, you don't really, know who they are. So that's what's happening. So these are your early ICO and crypto traders. This is who those people are selling to, right? So when you ICO, and the moment you get it listed on an exchange, those are the people that are buying it from you. I really like these tweets by Alex Marcos. He's from Chaincode Labs, our core developers, where he says, here's one big difference between traditional startup funding and ICOs. Founders of failed startups shouldn't come away financially enriched. Risk capital to explore ideas is great, but incentives aren't aligned if founders make money at expense of investors regardless of outcomes. And we're seeing this, right? I mean, you have people going from project to project to project. My biggest example is somebody like Dan Larimer, right, who went from BitShares to Steemit to EOS, and he'll probably go somewhere else and start another useless blockchain. I highlighted on that as well. Basically, to me, all ICOs are just centralized schemes. They're basically designed, they're either securities or they're printing your own money, most of them, like 99% of them. And it's just there to separate your hard-earned dollars or Bitcoin for their ideas. Like, think about it this way, right? How many of you have like a relative, like a cousin or an uncle or a nephew that has these crazy ideas and he's trying to borrow money from you for those ideas? He's probably more responsible and knows what he's doing way better than a lot of these people with these ICOs that you're actually buying, right? Just think about that. This is what makes Bitcoin different. I have other presentations that specifically talk about what makes Bitcoin different. Now, I know I'm about 25 minutes in. I'm not sure how much time I have. This is actually a great video. Hold on, don't play it yet. So I would love to play it. I think it's about 10 minutes. It is totally worth it. I recently saw this documentary. It's called Dishonesty, the Truth About Lies. And it actually looks into how people, lie and when. And if I do have 10 more minutes to play this, I think it will be well worth it. There was one part here. This was recorded in 2012. Had nothing to do with Bitcoin. But there is one part that is very relevant to Bitcoin. It's called Distance from Money. And you'll see like a little Bitcoin thing flash on the screen. Say again? Can you finish up? Oh, that's it. The video is the end, and I do Q&A if there's time. Yeah. All right, cool. Let's play it. I basically compiled 10 minutes out of the 45.
And I'm interested in human behavior. I'm interested in rationality and irrationality. I'm interested in the cases in which we make good decisions and the cases in which we make bad decisions. And in the last few years, we've been focusing on
great
Bitcoin.
distances, could it be that as these distances in all of their versions are increasing, people find it easier to misbehave and still think of themselves or ourselves as good people? And I think the answer is absolutely yes. We took all the elements that we studied and we combined them into one environment. We will get an environment that is very similar to the one that operated in the financial crisis of 2008.
Not in generations has Wall Street absorbed the number of body blows it took today.
3 of the 5 biggest investment banks are gone. The country's biggest mortgage lender is gone.
We had politicians, bankers, regulators, and even investors, all influenced by many factors: self-deception, social norms, distance from money, lying for the benefits of others, and of course conflicts of interest. And this is what I think corruption is all about. It's about that when you get into a system and something in the system tells you that things are wrong there, all of a sudden you abandon your own moral fiber. And because of that, we really need to figure out what can we do about it. How can we get people to behave better? Because if we don't, we're just going to get more and more disasters like the one we've just experienced.
Many of the experiments that we have conducted are about trying to find ways to curb dishonesty.
We went to UCLA and we asked about 500 undergrads to try and recall the 10 Commandments. How many of them do you think recalled all 10 Commandments? 0, that's right. By the way, they invented lots of interesting ones. What happened after people tried to recall the 10 Commandments, even if they weren't successful? Nobody cheated. It wasn't as if the people who remembered more commandments, the people who are presumably more religious, cheated less, and the people who remembered almost none of them cheated more. Nobody cheated.
It didn't matter what religion the participants had. You know what the 10 Commandments are about. They are about a moral code, they are about proper behavior, and just knowing that and being reminded of that decreases dishonesty.
In fact, even when we take self-declared atheists and ask them to swear in the Bible, they stop cheating. It is not about heaven and hell and being caught. It's about reminding ourselves about our own moral fiber. We found this result to be very promising, but we wanted to test it in a non-religious context. So we went to MIT and we did a similar experiment with honor codes. So we got students at MIT to sign the honor code. I understand that this short study falls under the MIT honor code. They did it, shredded a piece of paper. What happened? No cheating whatsoever. And no cheating whatsoever despite the fact that MIT doesn't have an honor code. Then we replicated the experiment at Princeton. Princeton has a very strong honor code. In fact, the freshmen get a whole week of crash course on morality, lectures, discussion. So we took the Princeton students signing the honor code and not signing the honor code, the MIT students signing the honor code and not. Was there any difference? No. When they did not sign the honor code, they both cheated to the same level. When they signed the honor code, none of them cheated. And I think this is kind of a mixture of good news and bad news. The bad news is the crash course on morality, particularly the Princeton version, doesn't seem to have any effect 2 weeks down the road. The good news is that even without a crash course, reminding people about their own moral fiber does change how people behave.
All right, guys. Hope you enjoyed that. All right, so I'm done with this. Just go to the next slide. Oh, I got it, actually. And that's it. So you guys can look me up. I have a YouTube channel. I try to do daily videos, though when I travel a lot, it makes it more difficult. But other than that, check out the audio podcast or the YouTube podcast. And also pretty popular on Twitter. But otherwise, thank you. Thank you for staying out late tonight.
Thanks a lot, Tone. So you'll be staying here and have a drink on the back, right?
Yeah, I'll stick around.
So if there's a question, please touch base with Tone, and you can respond to this. It was very illuminating about human fabric, right? I mean, 70% are cheating. So what percentage in the audience is it?
But most of my videos are about like finance and price, and everyone seems to look to me for some kind of price prediction. So I do my best, but yeah.
Thanks a lot.
Thank you.